Good afternoon, and welcome to yet another episode of the JSE Stock Pick Series. This is an online stock analysis series that launched in August 2021 and is brought to you by the Johannesburg Stock Exchange. My name is viljoen. I head up the equities and equity derivative business here at the Johannesburg Stock Exchange, and I will be your host for today. For those joining us for the first time, I'd like to say a warm welcome to you, and I hope you enjoy the program that we've got lined up for you. And to our returning viewers, welcome back. It's really great to have you with us once again. Now, in the ever-changing world of trading, professional opinion is very valuable when picking a stock to include in your stock portfolio. In this series, we bring in independent industry heavyweights that take the audience through their stock picks and other security picks. And most importantly, why one should consider these stocks when building their portfolio. Without further ado, let me introduce our esteemed panel members. With us today, we have four experts: Tamsan, Chief Executive Officer at Shiloh Capital, Pete Viljoen, Director at RECM, Chantal Marx, Head of Investment Research and Content at FNB Wealth and Investments, Bright Khumalo, Portfolio Manager and Analyst at Vestect Asset Management. I'd like to say thank you very much to our panel members for your willingness to share your tips and insights with our viewers. Before we get started, I just want to recap the format of the event. Each speaker will present their top three SA stock picks, and we're focusing specifically on small caps. The time allocation is about 2 minutes per stock. And really the idea is to go through the investment case without the market jargon. Essentially, what is the stock? What is the supporting thesis behind the investment? Why are we choosing the stock? And what is the outlook on that stock? To our audience, I'd like to mention that there is a repeat broadcast if you want to go through this episode at a later point, and also that you can post your questions and we'll be able to address and pose those to our panelists. If you can aim to post as soon as possible while we're still while that speaker is still speaking, before we move on to the next speaker. Let's get right into it. Tamsan, I'm going to start with you. If you can take us through your picks, please. And before you do so, if you can maybe give the audience a sense of who Tamsan is and maybe tell us something interesting about yourself.
Thank you for having me. Appreciate that. I'll keep it short and sweet. I think, contrary to most people in finance, I'm a drummer, so I play drums for my downtime. And the quirky thing I will say is my younger brothers are twins, so I was always ganged up on it as 2 versus 1. Straight into the stock picks. My first stock pick is Stadio. Stadio is a private higher education business that provides two things: accessibility and affordability of tertiary education. They were spun out of another PSG entity called Curo, and they focus primarily on tertiary education. They are providing quality access to individuals who are unable to reach tertiary education, especially with the current larger institutions in the country. They've taken advantage of the rising demand in education, especially on the tertiary side. So when we look at their performance, their price has gone up 35% over the last year. Revenues went up 16% to 1.4 billion. Their net profit or net income went up 25% to 208 million. So the investment in campuses and online have proven to be quite a great way to conduct business. Their enrollment numbers have gone up. And one quick side comment is they sponsor the Craven Week, which is a good target market, given that a lot of young rugby players are looking to be professional and they don't necessarily have the ability to go to a fixed campus. So with their online courses, they're able to help individuals like that get an education. So why is this stock important? It has a PE value of 23, which is relatively moderate, price earnings ratio, relatively moderate to its peers, and there's a lot of growth still priced in it at 23. They declared a small dividend, so they've got a 1.5 dividend yield. But in terms of their investment in campus infrastructure, their acquisitions, their online programs, they're well positioned for growth and continue to attract quality teachers, quality lecturers, and are able to build a great, accessible and affordable platform for tertiary education, which solves a big problem in South Africa. And my second stock pick is Santova. Santova is a supply chain and logistics solutions provider. They provide end-to-end solutions, warehousing, for freight forwarding, and information management. They've started to grow well, especially around the data. They've got sales offices and or exposure to South Africa, to the UK, and to parts of Asia. So they're really strong in that area. They've grown their global base, especially around trade and e-commerce. They're resilient in their growth. They're growing steadily. They've got good revenue and profitable growth. They've invested in new technology that enables them to advance their e-commerce, call it solution provision. They are boosted by rising volumes, especially since COVID, and they've managed that well. And that is balanced well by their digital capabilities, which they've brought to the fore. The case for the stock, they have a price earnings ratio of 8, which is undervalued in comparison to their global peers. They're very cost sensitive, so they manage their cost well. They've got a healthy balance sheet, strong earnings growth. And if you're looking for a pick in logistics at a great valuation, the stock is for you. My final stock pick is Storage. They are the leading South African self-storage REIT. They have exposure to both South Africa and the UK. They are defensive stock. They weather a lot of storms in the economy. They focus on quality long-term leases, which enable them to fit in perfectly into the REIT space with good growth and income balance. They've got a strong defensive performance, recurring rental income. They've got high occupancy rate, which is important. And I think the key part of their business model is that they're resilient to downturns. So if you're looking at some form of defensive small cap, this would be it. Their growth is due to expanding to underserviced locations. So places where storage is required, but there's nobody in that space. They are a good balanced option for both income and growth. They offer a 6% dividend yield, and their valuation is supported by their price to NAV, showing that they're trading close to intrinsic value of their assets. Their portfolio strategy, as you said before, benefits from strong and stable long-term leases. And I think as a business, they're going to have a good future, especially with their diversified portfolio. Those are 3 stock picks. To also say that we own these shares ourselves, so we want to make sure we're not contradicting ourselves by speaking of things we don't own. But we have a view that these 3 stocks will grow and will provide great income for investors going forward. Thank you.
Thank you very much, Tamsan, for your thoughts and insights. I would like to say as well, please do invite us to a drums concert. I
will do.
I'm checking to see if there's any questions. I don't see anything as yet. Maybe a question from me. Given that we're in the rate cutting cycle, do you think that will impact any of your picks going forward?
Well, firstly, I don't know if it's going to be a cycle. The world has changed. It changed yesterday. So we don't know if it will be a cycle, if it will be a once-off. What we will say is that part of this portfolio pick was we had a growth stock, which is Stadio. We had a stable revenue earner, which is Santova, and then we proposed a defensive stock, which is Storage. So it's a balance in the portfolio. And I think regardless of what happens at the Reserve Bank, I think this sort of portfolio will give you a balanced rate of return.
through from Dumisani Sibanda. He says, for those that have just completed varsity college, please advise on how they can enter the industry to gain exposure in investments and derivatives world. I suppose that's not really specific to your stocks, but if you have any thoughts on that.
Well, I'm not a human capital expert, but what I will say is start doing the investment on your own prior. You don't necessarily have to put up cash. There's many platforms that allow you to trade with a dummy portfolio. So you can show your track record and your ability during the course of your degree. And at that point, then you can present your performance, not just your CV. And that would differentiate you from other participants in the market who haven't displayed that. But yes, T's and C's apply on my comments. I'm not a specialist at recruiting financial services talent.
Thank you very much. Just to summarize your picks, your first pick was Stadio, second pick Santova, and then Storage.
Correct.
Thank you very much. Now we're going to move on to Chantal. Chantal, as mentioned, she's the head of investment research and content at FNB Wealth and Investments. Chantal, the floor is yours.
Hi, yes. Well, I mean, you wanted us to say something interesting about ourselves, so I've been stressing about that for about the last 15 minutes. I usually say I like lifting heavy things, and that is still true, but I think people are tired of hearing that by now. So another interesting thing about me is I really love to travel, but I love it even more to come home. So I travel a lot, and I'm always so relieved to be back in South Africa. And that is especially true today after the events that happened across the world yesterday, or particularly in the US. So in terms of my picks, there's a really nice rule of thumb in order to actually screen for particularly smaller cap stocks. You can look at the dividend yield of a stock and compare that to the price earnings ratio. And usually when the dividend yield is higher than the price earnings ratio, it's worthwhile to have a second look at the company. Sometimes it's a value trap, but a lot of times it's actually a really nice signal that the market is mispricing a stock that is cash generative, but not necessarily getting the rating that it's supposed to be getting. So all three of the stocks that I chose actually have forward dividend yields. So that means the expectation for dividend payments over the next 12 months relative to price higher than their 12-month forward price to earnings ratio. The first stock among my selections is Master Drilling. So this company plays in the mining space, but they're in services. And the service that they offer is they actually just drill exceptionally big holes, and they are very, very good at it. They obviously have a pretty substantial moat because it is very difficult to build out that capability and the machinery required to execute. And they have proprietary technology that they've created over the last 40 years that is very difficult to replicate. They have a big presence in South Africa, but a growing presence internationally, both in kind of the South America, North America region, over in Australia, in Southeast Asia, and also now a growing presence in the Middle East that expands beyond just mining, but also in the broader construction space. So this company obviously is exposed to commodity cycles. And we do think that it would be natural for it to come under pressure when commodity prices are under pressure and when capital expenditure, particularly in the mining industry, is pulled back, which is what we've seen now. But the reality is that we've seen massive underinvestment in supply in many commodity types over the last decade or so. And the expectation is that we will eventually have to start seeing that capex being spent in order for us to actually meet future demand, particularly for critical metals like copper. And Master Drilling will benefit from that. The stock is trading on a forward PE of 4.5 times, which is exceptionally cheap and offers a forward dividend yield of 5%. So it kind of ticks that box of that really rough rule of thumb. we have seen a total return of about 12% over the last year and 6% year to date. So it's underperformed the market. And from a long-term perspective, I would be really comfortable holding the stock. They have a very steady balance sheet and they are highly cash generative with a very solid management team as well. Then my second stock is capital appreciation. Again, using that little rule of thumb, we've got a company that's trading on a forward P of 7.6 times and a forward dividend yield of 8.6%, which is really, really attractive. The company specializes in payment. It's a fintech company, so that's a really nice thematic space to play in. They specialize in kind of payments, which is mainly a terminals business. So the card machines that you kind of swipe or tap your card on, they source and upgrade and load software and kind of write the software and distribute and hire out and sell those terminals. So they really have a presence across that entire supply chain. And they really are, at this point, still growing quite rapidly and are one of the market leaders in the South African market. What's really interesting right now for the company is that there's a massive requirement to upgrade terminals at the moment from 2 and 3G technology to 5G compliant. And that has resulted in them having to replace that entire real estate and really has driven sales in that specific business. The software angle is also quite interesting because it follows a subscription model, which offers really nice annuity income. And then they also touch in other areas of the fintech space from a software development perspective. And I think that there's still a lot of growth run rate there. The expectation is for this company to, over the next few years, grow earnings by about 30% per annum. So a 7.5 times forward PE is still very cheap, even though we have more recently seen a really nice re-rating in the stock. About 3 or 4 months ago, we had this company still on like a 5 forward PE, but I think that it still has some room to go. And then my final pick is Lewis, more cyclically exposed. We spoke about the interest rate cutting cycle, which kind of now looks more like a stripe with a slight slant lower. But Lewis has actually shown us that they can do quite well regardless of where we are in the interest rate cycle. We've also started seeing some green shoots from a consumer confidence perspective, and we have started seeing furniture and homeware sales increase, not only for Lewis, but for other players in the market as well. I think confidence is very important when making big purchasing decisions, and for a lot of South Africans, purchasing furniture and appliances is actually a big purchasing decision. But I see Lewis doing well in this environment. They've taken a lot of unnecessary costs out of their income statements as well. They're highly cash generative. They've really improved on data collections. Their book looks a lot healthier than it did a few years ago. And we had a very encouraging trading statement from the company a few days back, where they said that headline earnings per share for the year is going to increase by, I think, more than 45%. So I think very, very solid at the moment, and going into what could potentially be more interest rate cuts and decent consumer confidence. The stock is trading on a forward PE of 5.8 times, still looks very cheap in the context of that near-term growth profile, and offers a forward dividend yield of 8.7%. Again, a really attractive dividend yield on any measure. And yeah, that's my story. Thank you.
Thank you very much, Chantal. So, Louise, I think one of the good things with that stock is that the retail segment of the economy has been quite strong, and I see year-to-date performance of the stock is quite good, sitting at about 72% yet on a year-to-date performance. While we wait for the next question, maybe a question from me: do you think if, for instance, there's a reversal of the cutting cycle, if I call it that, Tamsan, if we start to move back sort of into a higher rate environment, how do you think that will play out for a stock like Lewis?
Yes, so I mean, as I mentioned as well, it is definitely a cyclical stock. But if we look at our interest rate outlook for the next few years, we don't expect a new hiking cycle before, let's say, 2027, 2028. So it still has a lot of runway. That can change quite quickly, though, because we do have things that are outside of our control that could at times dictate inflation in South Africa, particularly if we see some rand weakness, or we see an inflationary impulse from supply chain issues emanating from perhaps Donald Trump's decisions that he makes around kind of trade regulations. But all else being equal, and in terms of what we can see right now, we don't see that happening in the next 2.5 years. In that case, you would see a company like Lewis coming under pressure. You will see discretionary retail come under pressure more generally, because investors will, consumers rather, will feel like they don't have that comfort anymore on spending a lot of money on something like a new mattress or a new lounge suite or a TV. You have to start thinking more about, putting food in your mouths.
Thank you very much. Much appreciated those insights. Maybe just to recap Chantal's picks, master drilling was pick number 1, capital appreciation, the second pick, and then Lewis, the third pick. Thank you, Chantal. Now we'll move on to Pete. Pete, if you can start off with something interesting on your side, and then we can get into your picks.
Yeah. The only interesting thing I can really say about myself is that I've been managing money for over 30 years now, and I intend to manage for at least another 30 years. So, I'm doing everything I can to carry on. With that as background, I've picked 3 stocks, as I was instructed to do. But I have to say, by way of introduction, that I think at the moment in the South African market, you have a very interesting confluence of events. The one is that South Africans have basically taken all the money invested offshore and withdrawn it from the local market. So there's been massive forced selling of local stocks, especially small and mid-cap stocks, which aren't in indices and which the large fund manager can't buy. So their share prices are depressed, not because they're bad companies, but because there has been forced selling. So across the board in the small and mid-cap sector, share prices are very low. On top of that, the companies that are still around today that have survived the past 10 years of this economy, which has been going nowhere, are good companies with good management by and large. That is how they've been able to survive. So you have this confluence of events where you can buy good companies at low prices, and that doesn't come around very often. So I've got 3 stocks here. But I could have picked 10 or 15 or 20. There are so many, and we've already heard of 6, and they're all really good potential picks. So let's kick off with my picks. The first one is a company called Argent, which has a reputation as a steel bashing company. If you ask people what Argent does, they'll tell you it makes things like the Expander range of security systems or American shutters. But what they don't know is that this business has been steadily but surely been divesting itself of low return businesses and taking that capital that it's raised from the sale of those businesses and investing it into a high return business, to the extent that it's upped its return on equity over the past 10 years from 6%, which is a steel bashing bad industrial business return, to where it is today, 16% and increasing. And the reason they've done this is because about 6 years ago, a very astute investor took a significant stake in the business and started taking control of the capital allocation policies of the business. So you have this result. A growing business on generating decent returns on equity, and those returns on equity will increase. And if you look at the valuation, it's on a PE of 6. And the price to book is trading at less than book value. So paying less than book value for a book, the equity that generates more than 16%. And I think that is a bargain. And you don't need interest rate cycles or economic growth or anything else. It's a self-help story, and you'll do fine. If you have economic growth, that's a bonus. If you have lower interest rates, that's a bonus. But you don't depend on that. You depend on the management of the company allocating capital properly, as I've done over the past 10 years, and you'll make a good return out of that. The second company I've chosen is a company called AdCorp. I see the S's are dominated so far, but I'm choosing the A's, so I'm sticking with AdCorp. It's my second stock. AdCorp is basically what you call an employment agency business or a staffing company that has basically been restructuring itself for the past decade, for the past 10 years. Previous management expanded too quickly, and also labor legislation changed a lot, and they have been forced to change the way they do business, and it's taken a long time to adapt to the current environment. We think the last set of results contains a last set of adjustments, and this business currently, if you normalize the earnings, given those once-off adjustments and last set of earnings, is trading on a PE of 4, but there's more. If you look at the balance sheet, there's 280 million rand of net cash sitting on the balance sheet, and this is a business that has a market capitalization of 500 million rand. So that more than half the market value of the business is in cash. It's not in the business, it's just sitting in cash. So actually, if you look through the whole business, it's sitting on a PE of 2. Again, so if you buy the share at the current price, you're looking at 50% earnings yield. Again, it doesn't need lower interest rates. It doesn't need a strong economy. It doesn't need any help from outside. The price is so low that you will do well regardless of the environment. If there is to be economic growth, a staffing business like AdCorp will fly. And you can acquire this business on a PE of effective PE of 2 times today. It's trading at a third of book value. So again, that's those are the sort of valuation metrics for that business. The third business, I'm straying away from the A's now. I'm into the M's. I skipped a whole bunch of companies to get down to the M, because there's a whole bunch of companies between A and M you could pick as well. The third company I've picked is a company called Merafe. Merafe is basically the JV partner of Glencore in its ferrochrome smelting business. Now, that doesn't sound very sexy, but the beautiful thing here is that the capex has been spent, and all they're doing is smelting the chrome into ferrochrome. And South Africa is one of the major sources of chrome in the world, and ferrochrome is used in making stainless steel, and the demand for stainless steel grows year in and year out globally. So the interesting thing here is that this business is cyclical. There's no doubt that ferrochrome prices are cyclical, and its costs are cyclical. Currently, earnings are quite high, so it's no surprise to see that it's trading on a PE of 2 times, because earnings are so high. It's actually on a dividend, historical dividend yield of 35%. So we expect earnings to come down over the next year or two. But if you look at Merafe on a 10-year view, if you take 10-year average earnings, and that you do that to smooth out the cyclicality, it's sitting on a PE ratio of 5 times. So yes, earnings will be down next year, but they're going to be up in 2 years' time. That's how it goes with these cyclical businesses. As long as you don't pay too high a price earnings ratio on average earnings at the time, I think you'll be fine. And the kicker for me in Merafe is that it doesn't suffer from the capital misallocation risk that most mining companies face, where management tries to allocate capital towards new mines and new ventures to protect their jobs. Merafe is, as I said, the joint venture partner with Glencore in its smelting businesses. Glencore holds the purse strings. Merafe just picks up the cash flow and pays dividends. That's all it does. It doesn't expand into all sorts of other areas or diversification efforts like a similar cash flow generating company like Exxaro, which is going into all sorts of low return business like renewable energy and nonsense like that. These guys stick to their knitting. They are ferrochrome smelters, and that's what they do, and they return the cash to shareholders over time. So this stock is available on a PE of, through the cycle, of 5 times, which we think is a bargain. So just in a summary, these are 3 picks. I could have picked 15 or 20 other stocks, including the ones the co-commenters already mentioned. I would add that the common denominator across the three companies I've picked, which I think is very important if you're investing in small cap companies, is capital discipline. Is management doing the right thing with the capital? And I think that's a common thread between all three of these stocks. Thanks, William.
Steve, appreciate your thoughts on that. Just zooming in on your last pick there, Merafe, considering that it's in the mining sector. So yesterday there was the small event in the US with the elections, and we saw the sell-off in commodities. There's obviously the China narrative and so forth. Do you think in the long run, or let's say over the next 4 years, that's likely to have any bearing on Merafe's performance?
In the short term, anything can happen. And as I pointed out, it is a cyclical business and its earnings are quite high at the moment. So one would expect the earnings to decline going forward, whether it's a result of US elections or China or whatever. One never knows what causes these things. But when earnings are high, you expect them to decline, and when earnings are low, you expect them to go up. I mean, that's basically the only forecast you can make here, and that's why I use 10-year average earnings to work out the PE ratio, because we don't really know how things will play out. A lot of people will tell you they know, but I just work off this supposition that I don't know, and therefore I don't want to pay a high price relative to average earnings over time for a cyclical business like this, which where prices are out of your control, as you point out.
Yeah. Thank you, Pete. Just to reiterate your picks, Argent, that was your first pick, which is in the steel industry. EdCorp was your second pick, which is provides workforce solutions. And of course, Merafe was your third pick. Thank you very much, Pete.
Thank you.
Now we move on to Bright. Bright Khumalo, he's a portfolio manager and analyst at Investec Asset Management. Bright, over to you. If you can start off as well with something perhaps interesting on your side, what the audience can learn.
Hi, Vuyo, thanks for being in your show. The fun fact about me is that I've been since the first show, I think it was in 2021. So I've had many picks. Hopefully one day we can jot them down and see how they've done over time. But since we're doing this online this time around, can everyone confirm they're not a bot? By putting an emoji of pants and fire next to them, especially if everyone did remember to wear their pants for this session. I just want to see some emojis, the pants emoji and the fire emoji, to see if everyone's still awake. Yeah, but anyway, something interesting about me is that I'm actually doing this session in the office, and behind me is a vine of vanilla. We put these up in 2019 when we moved and bought these offices from Melrose RGA in Rosebank. These depict actually our model portfolio, especially the anchor positions. The idea was to plant them. They go from left to right, which is what you want, right, in the long term for good investments. But they've grown so much that they go all the way around and back to the top. We had to create a whole thing to try and hold them together, which is pretty interesting. But as you know, investing is not always perfect. You do have companies that go to zero or they don't perform as you expect. So in this is a second sort of a pot that holds these vines. It's actually empty. There's a small vine growing there again, but the vines that were there, they all died. So sticking with investments there, it's also teaching us that nature, and just like in investing, it's not perfect. So now straight to my picks for the day. I'll start with Edvitech, which you all know is an education, a diversified education group that's based here in South Africa, obviously, since it's in the JSE. And I like this pick because it's proven time and time again, against all odds, that it's a very strong quality business. Think of times like during COVID, they were able to adapt to the changing environment, and kids were learning online. It was very stressful for the parents, but it worked out for those couple of months, or close to a year of learning from home or distance learning, and obviously that grew their capabilities to that part of the business. The second one that I can think of, which is very big and very sector specific for them, was the semigration and the immigration of South Africans to different countries or to different provinces, including Cape Town being one of their favorites. This company was able again to be very stable in those periods, which no one expected, but they seem to be just trotting along with high return on investment for the business. They've been paying dividends consistently, thanks to their strong brands, which not only include primary schools and high schools through Varsity College, Crawford College and Trinity House, but they also have tertiary education that competes with Tamsan's favorite pick, which was Stadio. Here they have Varsity College, like one of the guys who asked the question went to, and they offer degrees such as BCom accounting there. They've got Rosebank College, which also offers different accredited diplomas and other qualifications. There's also a recruitment business in the background there that provides solutions across various industries, both locally and internationally, which is something they also use in their own businesses to help with staffing demands, which is pretty cool. So Pete will like this one as well because it does have that Ed Corp aspect to it. So that's the story with Advitech. I like Advitech a lot. I think I've picked it numerous times in this show, as well as Stadio. But I think if you were to make a stew, to echo our late Tito Mboweni, you will need a very strong source of protein. And I think Advitech is that protein in this meal that we're cooking today. The second pick for me is Sebvest. Basically Sebvest is a diversified investment holding company run by founded by Chris Seabrook, who is a seasoned capital allocator who's been able to compound cash into many rands in the past, call it 20, 30 odd years of what he does. Currently, their portfolio has quite a lot of things in it. I'm looking at it right now. Some of the companies that you might know that once were listed on the JSE include ARP Holdings, which operates in the electrical distribution business. We've got Classic Food Brands, which they've got brands of alcohol. The one I can think of right off the head is the gin. Bavaria, also non-alcoholic drinks are also in there. They've got Halewood. They've got Rolfs, which is also another company that used to be listed on the JSE. They've got Correro Network Securities PLC, which is a listed cybersecurity company in the UK. They've got Metrofile. They've got Transaction Capital, and by Essence, We Buy Cars. So they've got a mixture of good businesses there. The thing I like about it is the management, like I said, and their long-term focus, by adopting a very long-term investment horizon to doing what they love, and the diversification, obviously, of the portfolio itself. So if you're not good at capital allocation and you're new into investing, maybe looking into something like a well-run holding company, you could look at Sebvest because it has beaten its peers who are much larger, who can't allocate capital as freely as they like because they would need to do massive deals to actually move the needle. But here at Sebvest, you've got a family-run business that's, they can allocate capital quite good. And at the current discount to NAV, it makes sense to start chipping away and building a position into this. So going back to our analogy of cooking a very good stew for Tito Mboweni, this will be, your spices, your green and red pepper, your toppings to make this thing actually quite nice and tasty. You need a company like Sebvest. And the last company that we're looking at now is going to be Fairvest. Excuse, the rhyming here. It was not intentional, but I'll run with it. So Fairvest basically is a REIT, excuse me. It focuses mainly on, owning, managing, and developing retail, office, and commercial properties. As it stands, according to their last set of numbers, retail was around 68%, office was 21%, and industrials was around 11%. Another company that survived COVID and were forced to fix their balance sheet in terms of making sure that those loan to value numbers make sense, but they were least affected, by COVID because they invest in retail. In the retail space, they focus on non-discretionary items, so their properties basically are close to where the people are. And in those malls, they actually focus on things that people need, not wants. This is not a mall where you're gonna get a Bounce or a bowling alley, but instead you're gonna get a Checkers and a ShopRite, because those things we need. And as a result, they provide a very defensive portfolio there. And another interesting, kicker for that business is that they completed a merger with Arrowhead Properties, which led obviously to a much more diversified property portfolio, enhancing those yields that you see. And Arrowhead, for those people who don't remember, they used to focus on more sort of units that focus on individuals that like to rent. Also, again, in the more affordable space, so we're talking about higher yields here as well. But they manage these things quite closely and they watch everything like hawks. So yeah, these are the picks that I'm looking for. And obviously, a low interest rate environment is good for things like Fairvest, because there will be something that goes straight down to distributable income, and they pay that as a dividend to you, the shareholder. So as long as they manage those loan to value numbers below the, call it 40, 35%, this is a good one to invest in. And I did look at other smaller players. Maybe you guys can tell me on the comments which ones you like. Things like Vukile, for example. But I think Fairvest is the one that stood out for me because they're not doing too many things at the same time, and they're not going aggressively into jurisdictions where they don't really have insights, or if problems do occur, they can, tackle them head on without needing to take a flight and being, in the air for 12 hours or even more, like some of their counterparts do. So these are my picks, and I really like them. And to finish off our metaphor, Fairvest will definitely be, since they operate in the property sector, they'll be our stove to provide us the fire that we need to get this stew going. RIP Tito Mboweni, and thank you very much.
Thank you very much, Bright. The late Tito Mboweni was known to be quite a chef in the social media circles. There's a few questions there, but maybe before we get to those, Bright, Fairvest obviously has a couple of classes of shares, Class A and Class B. Would you mind just simplifying that for our investors in terms of what the differences would be there in terms of where should they be looking, for instance, between those classes?
Yeah, you're looking for financial advice now. You're getting into murky waters. So I would say do your own homework and take the ones that you like. But typically, in the past, from what we've seen, this is not the first time there's a Class A and Class B. We've seen Resilient, we've seen other property REITs have these similar structures. Essentially, the A's would have guaranteed, distributable rate, call it a 10%, and everything else that's left over is sent into, the B's. But again, like I said, you should do your own homework. You shouldn't believe a guy with a beard wearing a green shirt online tell you what to invest in. You have to still do your own homework.
Correct. One more question for you, Bright. This one is addressed to you specifically. They're asking, are there any startups worth mentioning that you cover on your side? I guess this goes beyond the 3 picks that you've mentioned.
Sure, there's quite a lot of startups that I do follow. Obviously, we follow a lot of US listed companies, and there's quite a lot of startups in the space that supports the AI cloud. So those clouds tend to be very different than your usual Microsoft Azure or AWS cloud businesses, where all you need is a bit of storage and not much processing power. But these newer AI clouds focus on language learning models, and those obviously need a little bit more processing power. So they use the NVIDIA Hopper H100 processor, and as a result, we like these things, and obviously we'd like to catch them at listing, like we did things like ARM, for example. So we do watch a lot of these small startups that are based in Silicon Valley or outside Silicon Valley. So I can't name all of them in one sitting, but for those who are interested, put your comment there. We'll do drinks soon.
So thanks, Bright. Just to recap on your picks, the first pick was Advotech, the education company, and then second
the protein, the main
protein in the stew, of course.
Yes.
Subvest was the spice, and then Fairvest, I think you said that's the stove powering the meal. Thank you, Bright. We have only a few minutes left, and I'm just going to maybe open up to a couple of questions. Pete, if you don't mind, I'll bring this one to you. It's a general question. The question is around, how do you determine when it's the right time to let go of a stock? So you've gone for a stock and maybe it hasn't worked out in your favor, or maybe you're sitting on some profits there. How do you determine that now is the right time to get out of this position?
Yeah, I think there are three instances where you would want to sell a stock. The first one is where you realize you've made a mistake in your analysis and it's not working out because of that mistake. Then the best time to sell is immediately. Another reason to sell is if the investment thesis has changed. I mean, as you read the results, as the results come out every 6 months for these companies, and management has the area where they discuss the business. And if you buy a stock for a certain set of reasons and the environment changes so that those reasons are not valid anymore, that's another reason to sell. And the third reason would be if you have a better opportunity. The hurdle rate a stock has to pass is your next best opportunity always. So if you find something else that has a higher expected return, significantly higher, there's to be quite a wide margin of safety between the two, then you would sell the one to buy the other one. So those would be three reasons to sell a stock.
Thank you, Pete. Tamsan, let me come to you with this one. The question is it correct that with small caps, capital growth is really minimal to non-existent, that you really have to rely on dividend income for your returns?
No, absolutely not. Capital growth is possible with small caps. In fact, you're probably going to get a higher capital rate change. I mean, easy equities as an example, went as high as R3 at some point. So if you had invested in it at the 30-cent mark or the 50-cent mark, you'd have gotten significant capital returns. So I think what's important is to understand what stock you're buying into, how they make money, how they are protected from competition, as in what's their moat, and do you understand the industry and how they go about generating income. If you have some understanding of that and you compare that to its current market price, and you see that the price it's trading at is below what you deem as value, then it's a good stock to invest in. Growth stocks will always have volatility. Small caps, so as much, but there is an opportunity to make significant returns within the small cap market.
Thank you, Tamsan. We only have a matter of seconds, and Chantal, I'm going to come to you. If you can give us a very brief answer to this question. We have a young viewer that's currently doing matric. Good luck to them. They're asking about factors to consider when investing in companies. You did touch on some of these. Are there any others that that they should be looking at?
Yeah, sorry. So I think the main thing is you want high and growing cash flows. So that's going to be a very important underpin. You also want to know what is going to drive growth in revenue going forward. And then you want to know that the company is safely managed. So those would be the three key things. Do you like the management team? Does their strategy make sense to you? Sometimes you get I call it an ick when you meet a management team or you hear them speak. You need to investigate that a little bit further, because your first impression is usually right. But then do that work on the revenue line, see where revenue is going to come from, and then finally do the work on the cash flow statement. Make sure that they are actually translating profits into cash, because I think that once a company doesn't do that, it can be a red flag as well.
Very much, Chantal. And that brings us to the end of the program. I'd like to say thank you very much once again to our panelists for taking time to share your valuable insights. And I hope our viewers found the program as insightful as I did. And just a disclaimer to mention that the views expressed here today are of the guests and not reflective of the views of the Johannesburg Stock Exchange. Thank you very much, everyone.